Some of the famous investors, when they talk about it, I've never heard anybody talk about the power of the team. And personally, in Diamond Hill, we're very, very proud of the team dynamic that we've built. All of us in the international team, we have a stock picker mindset. We're always looking for that diamond in the rough. And we are also very collaborative. So very collaborative and close-knit. In fact, if you look at us, you would get different accents and different background, different skill set, but we're very complementary in how we think. We have the same philosophy, but different skill set. And so it's beautiful when that comes together. As a portfolio manager, I feel like my biggest role is to provide autonomy because you already know you have top quartile investors. If you can keep them together working in harmony and give them complete autonomy, because that's what most best analysts want is complete autonomy, you'll end up with, if you put a few of those top quartile analysts together, you end up with a top decile team. And that's kind of the philosophy that I have, that the sum was way bigger than the parts. Especially in an environment like we're seeing these days, to have a team come together is really what you want. Like you want people engaged and tap dancing to work when the market is down 10% today, up 10% tomorrow. That kind of volatility kills a lot of people's energy. And plus, at the end of the day, it's a more fun environment when you have a team that learns together in an environment of trust. People can say what they want. Typically, this industry tends to get very cutthroat and competitive, and we want to keep it more collaborative. And that's really the approach at Diamond Hill.
I'm Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Krishna Mohanraj, who is International Portfolio Manager at Diamond Hill Capital Management, an asset manager with approximately $30 billion in assets under management, headquartered in Columbus, Ohio. Prior to joining Diamond Hill, Krishna spent time at Sanford Bernstein and Exelon Corporation, and prior to that was a product manager and solution architect. Welcome, Krishna. Thanks for joining me today.
Thank you, Evan. Thanks for having me.
Let's start by talking a little bit about your background and how you ultimately came into the investment world, having cycled through some other roles before that.
I'll start with the short version of the story. I grew up in South India, came to the US to study engineering, worked for a few years in software and consulting. That was around the dot-com years. I saw the craziness of the markets, caught the investing bug. And I wanted to invest globally. So went to London to study finance, worked there for a while, like you mentioned, at Sanford Bernstein on the sell side, covering European equities. And then through a series of events, ended back in the US, and now I'm managing a global equity portfolio. I would say the big story here, the big observation here for me is that the background really, I think, is mostly by chance. Now, you do make a lot of decisions along the way where you feel like you're the driver in your career journey, but the crucial jumps for me happened by accident, by chance. And I think that the story kind of comes together only in hindsight. So if you look at my story, I'd say like I've been extremely lucky in two ways. One, I've had a very global experience. Like I've lived, studied, and worked in 3 continents. And without a doubt, that's shaped who I am and how I think about investing today. I think I've also been lucky in being in these places when there was a big down cycle. They say, it's the scars that make an athlete. And for me, most of my formative experiences have been some form of a down cycle, right? So I grew up in South India around the time when the country went through a major financial crisis. The country was actually reduced to airlifting tons of gold as collateral to the UK. So that was the kind of first experience I had as a child growing up to finance. And from there, if you look at where India is today, sort of the crisis leading to a need to open up the economy, bringing out the best in people, the quantum of change in lifestyle is just fascinating, right? And I've lived through it over all those years, and it's made an impact. The same with the dot-com years. Like I was just lucky to be working in a tech firm at that time, got paid in stock options, which amounted to nothing. And then you realized things can change fast. And then you saw the tech boom since then, right? Same thing, again, 2008, financial crisis. I was in Exelon in the trading desk, same ups and downs. And finally, when I was in Europe, I was working on the European banking desk. And if you remember the 2011, the PIGS crisis in Europe, that was when I ended up in that place. So lots of down cycles, both in developed and developing markets. which kind of changed your view on how to think about crisis and how to go through the investing journey. And honestly, if I sat down on day one and wanted to design it, I couldn't have come up with this. So I really feel it's a question of a series of happy accidents.
That's fascinating. I'm going to drill a little bit deeper now because I think we're all obsessed with the psychology of money, that book, or just the psychology of resilience and grit that comes sometimes from these so-called negative experiences, but actually that can be. So I suppose if you were to get specific, does that mean that you are less trusting at times, maybe of the top line soundbite? Do you want to verify? Do you buy the hockey stick projection? Are you somewhat more skeptical, perhaps? If you were to sort of say how that has made you approach, even, we're recording this in early April 2025, and we're dealing with some similar turbulence now. How would you say you approach business thanks to these experiences?
I remember this incident. I was on the sell side covering Southern European banks, and one of the banks, and this was the time when the banks had all blown up. This Spanish bank has had assets in the Costa del Sol, like the south of Spain, and the investor relations person actually came with a book of pictures of these mansions to show the investors, saying these are actually real things that we own on the balance sheet. That was how extreme skepticism was there in the markets. And if you roll back just 3 or 4 years ago, these stocks were trading at multiples of book value. So for me, the takeaway from that is not just to be skeptical. That is, I guess, par for the course if you want to be an investor. Be skeptical, do the work, etc. But also realize the difference between reality and what the market thinks can be huge, both positive and negative, right? And that's kind of what you're seeing today on a daily basis. And that's true all the time. Now, today, since you mentioned what is happening, I would say it's unusually noisy in terms of headlines. So today there's a certain mood. I mean, this morning there's a certain mood. This evening there could be a different mood. Tomorrow there could be a different mood. But in terms of how you think about it, you kind of go back to basic business analysis. And maybe we'll talk about this more, in terms of investment beliefs. It's about understanding what a business can do and focusing on that versus worrying too much about headlines.
And it's interesting that you mentioned coming from Southern India, because I've spent time in Hong Kong, and I do think these emerging markets, or markets that are off the radar screen of developed markets, often don't get covered very well in the media. So there's often a big gap between on the street insight and the headline. And I think that is perhaps where the alpha can be generated, perhaps in some of that, knowledge advantage. And moving now to the investment world. So you're an international investor. That hasn't maybe been the easiest mantle to carry for the last, say, 15 years until recently. Can you talk a little bit about your coverage and your philosophy and your investment beliefs?
Yeah, for sure. I think the last decade has been all about the US, and within the US, it's been all about the tech stocks. Whether it's the FANGs or the Mag 7 or what do you call it, or Nvidia. I think what's happened in markets in general is that there has been a period of huge concentration, and you find a situation where most investors and allocators are, I would say, extremely concentrated in the US and in the tech stocks in particular. And for the first time, I think they're feeling the pain of that. And you're beginning to see, I would say, a shift towards international markets. And that's really positive for us. And from our perspective, we've always said valuations are important, currency is important. And in both senses, international has been super attractive for a long time. So that's kind of the backdrop. Today, I would say there's only one story in town. The world seems to be coming around to accepting that there is a regime change. We are moving, we don't know how much, but definitely away from a truly global world to a more local world. And then the question is, how does that path look like, ups and downs? So that's kind of more current thinking. For us, what is the true north, right? That's the key. The true north, the philosophy for us is buy good businesses that you can understand. And why is that important? Because good businesses, you can actually have a 2, 3, 5 year view on, right? You can predict how much cash they'll throw out. And if you can predict the cash flows, you can value them. If you can value them, then you know when to buy them and when to sell them. And you buy them when they're on sale. So it all comes down to buy good businesses that we can understand and don't pay too much. Now, I'd say one more thing here, and that's important in the context of international. And I think you sort of alluded to it. International is a big pond with tons and tons of companies. A lot of them, unfortunately, are mediocre, in my opinion. So active investing is a lot more fun in international markets because you have to be selective and you simply start by saying no to a lot of things. So that's the sort of the core of our philosophy is say no to a lot of things and then dig deep, understand specific businesses that you like, and then end up investing in them.
That was actually going to be one of my follow-up questions. There is, I suppose, a theory that more inefficient markets lend themselves to act better to active management, and that sort of has been sweeping up international as well as emerging markets. Would you agree with that around efficiency and on, I suppose, the value added that active management can have outside the US?
Yeah, I would totally agree. I think what I would say is it boggles my mind that people buy an international benchmark because all you have to do is just look at the 2000 stocks in that benchmark and ask yourself if you would own any one of them individually. And for most of them, if you're a long term investor, the answer would be no for a variety of reasons, right? Their quality of the business, quality of the management team, the history of corporate governance, just history of capital allocation. In many ways, a lot of those businesses are not where you would want to be a part owner for a long period of time. Are there more of them in emerging markets than in developed markets? For sure, right? So there is more of a reason to be selective in those markets and avoid the benchmark. And hence, I would say over time, if you have the right approach, it's more of a reason to outperform in those markets.
And then of the ones that you would want to choose, I suppose one of the prevailing narratives right now is that the US exceptionalism was justified on the basis of the various structural headwinds that Europe, for example, was facing, whether it be excess regulation, demographic challenges, lack of innovation, the list goes on. Would you say that any of those are perhaps overlooked or overly simplified from our US vantage point? Do you see that some are perhaps just as compelling and in their structure as US companies?
Yeah, I would say, are there more good businesses in the US? Yes. But what we're looking for are good investments, not necessarily good businesses, right? And there's a slight difference between the two. It could be a great business, but if you're overpaying for it, that's not going to be a great investment. That's really the core of it. And I think people, when they talk about the secular, I guess, advantage that the US has, they also have to balance it with the fact that that's priced in. And that is, I think, the distinction between what I'm saying and I guess what the general consensus is. And of course, that doesn't mean your style is going to work. And we've seen for a long period it hasn't, because flows are driven, I guess the proliferation of passives and flows from passives, and they kind of have this dynamic of leading to concentration in the markets. But that breaks. When that breaks, it is going to be equally powerful in the opposite direction. And we've already seen some of that.
How about some of the technical factors, such as maybe the fact that certain economies, like say the UK, be more old economy oriented, maybe, as well as perhaps less liquidity, just more concentration. We've all heard about Novo Nordisk and Denmark and the concentration there. Do any of these technical factors get in the way of your strategy that would otherwise be simple, perhaps, if they were not there?
Yeah, it is not something that we worry too much about because essentially what we're looking for is companies that meet our investment mandate and the liquidity mandate that we have. Once we have that, we have the time horizon to be patient with those. In the short term, flows matter. Like flows are everything. China is suddenly attractive. You'll find flows moving from the other EM markets to China, and then that reverses in the next 3 months. So those things matter in the short term, but over the long term, you usually find that those things don't matter.
And the other key difference, I'd say, between non-US markets, certainly in Europe, say Australia, a little bit of Asia, is the focus, I suppose, being a bit more joined up, perhaps, with governments, with investors in terms of sustainability, energy transition. These are not politicized concepts outside the US for the most part. How would you say that, does that affect your investment approach at all? The looking for companies that are ESG oriented, or the fact that they are, does that affect any of perhaps their metrics, their financial metrics?
Yeah, that's a good question. ESG certainly gone through a cycle. It's had its ups and downs. And I think my view personally, it's always been the same. And I think it's just simple common sense, right? The kind of business you want to invest should be a business that survives and thrives for a very long time. So you want a business that's managed ideally for eternity, not for the next quarter or for the next year. And that means finding a sustainable balance across all your stakeholders. Now, the zeitgeist can change. Sometimes ESG is in the dustbin, other times it is everything. And you find some companies just resorting to, I guess, signaling versus actually doing real ESG. So you've seen all of that. In most of the markets that we look at, we've seen that cycle. But there are certain companies, the best ones, they always do the sensible thing for the long term, right? So they're not going to compromise on ESG, compromise on a stakeholder just because they want to maximize EPS for the next quarter, for the next year. Those are the kind of companies that you want to own. Those are hard to find among the public companies. And unfortunately, what you will find is the behavior of these companies is a little bit cyclical. They're kind of dancing to whatever music is currently playing. That is the reality. So for us, to the extent we can find companies with strong ownership, family ownership makes a huge difference, because then people want to do the right thing for not just even the 5 years, for 10 years and beyond. So our portfolio usually has a mix of companies like that. But unfortunately, those are not common.
And do you do any engagement? Is that part of your strategy at all?
No. Diamond Hill as a whole has not done engagement. I don't think it is a good use of our time in terms of what our strengths are versus how we can add value. We don't think that's the right place for us.
I want to now move to talk about team building, because you have a team that works remotely in some cases, but yet very cohesive. How do you approach building a team, cognitive diversity in that, and maybe how do you think the industry as a whole reflects cognitive diversity?
The surprising thing for me is, like most investors, some of the famous investors, when they talk about it, I've never heard anybody talk about the power of the team. And personally, in Diamond Hill, we're very, very proud of the team dynamic that we've built. All of us in the international team, we have a stock picker mindset. We're always looking for that diamond in the rough. And we are also very collaborative. So very collaborative and close-knit. In fact, if you look at us, you would get different accents and different background, different skill set, but we're very complementary in how we think. We have the same philosophy, but different skill set. And so it's beautiful when that comes together. As a portfolio manager, I feel like my biggest role is to provide autonomy, because you already know you have top quartile investors. If you can keep them together working in harmony and give them complete autonomy, because that's what most best analysts want, is complete autonomy, you'll end up with, if you put a few of those top quartile analysts together, you end up with a top decile team. And that's kind of the philosophy that I have, that the sum was way bigger than the parts. Especially in an environment like we're seeing these days, to have a team come together is really what you want. Like, you want people engaged and tap dancing to work when the market is down 10% today, up 10% tomorrow. That kind of volatility kills a lot of people's energy. And plus, at the end of the day, it's a more fun environment when you have a team that learns together in an environment of trust. People can say what they want. Typically, this industry tends to get very cutthroat and competitive, and we want to keep it more collaborative. And that's really the approach at Diamond Hill.
And given we started this conversation speaking about setbacks and, whether by accident or design, ending up in places that have taught you a lot, what would you say, any kind of setbacks in terms of investment mistakes that were particularly instructive in terms of what not to do going forward, whether backing the wrong kind of family or the wrong kind of management team, or perhaps misjudging the growth of a sector?
I have lots. So that could be its own podcast, but I would give you the general themes, right? Like it's pretty much every investment mistake in the book I've probably made, and we have made as a team over time. I would say it's less about specific learnings, because at the end of the day, every investment is a judgment call. You're not going to get that perfect investment that is the perfect business owner, perfect business at the perfect price. You're never going to get that. So you're always still making a judgment call, and you could be wrong. And it's not even one call. It's a call that you make over the life of that investment. At every point in time, you're deciding how to size it out. So I wouldn't come up with a list of mistakes. What I would actually highlight is how to manage the stress of making these mistakes and learning from them. And that, I think, is way more useful. Like, that's something I've learned over time. And I think on that count, the biggest takeaway is, don't make this about you. Don't make this your story, right? The stress comes from getting caught up in your own story, my career, my family, my ego. But every one of us, if you take a step back, you realize your story is decided by a lot of things that are not in your control. I think Buffett talks about the ovarian lottery, which family you're born in. You don't have a control over so many things like that in your life. So the best thing when mistakes happen, and I tell this to my team, is to remind yourself that this is not about you. This is about the situation at hand and making the best call looking ahead for your clients. And that's your job as a fiduciary. And the minute you stop thinking it's your story, your decisions start getting better because you know that your job is to make the best decision for your client at that point, not to worry about what actually happens, right? The result, you have this healthy disengagement with the result and the focus on the process. And ultimately, it's all about the process and doing that as a team. And that's what we focus on.
It's fascinating because if we were to take that kind of analysis into the companies that you invest in, you're obviously assessing that as a company CEOs, executive team, they also have the ability to operate under pressure and to pivot and to put their customers first and their shareholders, I suppose, first as well. What have you seen has been maybe either some techniques or some common traits that you've seen? Is it a question of simply time in the trenches? Is it a question of personality, skill? I think one of the things I see is a tendency to drink the Kool-Aid and to sort of become self-fulfilling that businesses can't go wrong, to underweight the risks. Anything that you've seen is something you look for in a team?
Yeah, I think with the management teams in general, one question I like to ask is what would you do differently if you were not a public company? Because then suddenly your time horizon stretches and your thinking changes. And usually you would find that there are some companies who actually think truly long term. There are very few of them. But what you're looking for is an honesty in them telling you what they're doing differently. In some cases, they are deliberately doing something differently because they have to, they don't have a choice. And I think that's kind of a starting point for me to decide whether I'm interested in engaging with this management team or not.
And just for people interested in entering the industry and becoming stock pickers, any ideas as to how you kind of build that mental strength to manage stress? Is it about your outside activities, your mindset you mentioned, and not making it about your story? Any other kind of tips that you maybe share with your team in terms of keeping the cool?
I've asked people for advice when I was trying to get into the industry, and a lot of people have said, "Oh, you need to start managing your money on your own. It doesn't matter how much it is, but you need to actually go through the motions." And I always kind of underestimated that advice because I came from an engineering background, and I was like thinking more about the power of logic and how you analyze businesses. And I was an analyst mindset, but I think that is the key, right? You actually have to go through and build that experience. You need the scars to get there. And I also think some people are more suited to it, so that you just have to know yourself to realize, are you in the right place or not? Because it's a very tough place to find out if you're temperamentally more of a follower than a contrarian. And being contrarian by itself is not the right thing, but if you have a slight edge towards not following what everybody says, then that's definitely a benefit.
So interesting. Continuing the reflections, is there anyone that has had a particular impact on you in your career, whether someone you've worked with who has counseled you, or even someone in the industry that you look up to?
I actually want to say something personal here. Like, I would say my grandmother, when I was growing up, she was my de facto teacher. She was at my house every evening, sat with me for a couple of hours, pre and post dinner as I did my homework. She made learning fun for me. Now, I probably would have done okay academically, but the difference was she made that experience fun for me. And that was the origin for me to disconnect the result from the work and to enjoy the work. I would have been a completely different person if not for her. And that is a stroke of luck, like going back to how many important things in your life are out of your control. I still think on a daily basis, what she's done for me makes a difference. And since then, a lot of people have helped me out as mentors, but the core of what I got came from there.
That's wonderful. You will be surprised at how many times grandmothers feature in this part of the podcast. Actually,
Oh, really?
tremendous
Okay.
amount. It's many well into double digits. And I suppose, what was her own story? Did she have a formal education? Was she a teacher of some kind? Or how did she do that for
So
you?
she was actually my grandmother's elder sister, and she was a spinster all her life. She worked in a church school as a teacher, and she was a retired teacher around the time. And so she as a spinster in a church, she had a very different mindset to learning. And I think in hindsight, I'm thinking if you had actually been through a family life, you're probably more stressed out versus her. She was always finding joy in learning, and that's been her mindset. And she kind of passed it on to me at that young age.
I love that image. And my last question is around any creed or motto. I mean, we've already touched a little bit on it in terms of your being focused, not making it about you in the approach to investing. But is there any maybe word of wisdom, advice for your younger self or other creed that you can leave us with?
I know what I'd say to my younger self. The unfortunate thing is, I know my younger self won't understand it. And what I'd say is really think long term. And it's not from an investing standpoint, it's more from a personal. So when you're younger, your time sense is very, very different, as I can see with my kids. But I feel like the part that kids miss out is that there is a big benefit to doing something for a slightly longer period of time. The benefits are like back-ended. Just to give some examples, if you want to play an instrument or if you want to learn a language, the positive feedback loops don't kick in for the first year, maybe not even for the second year. But the third year, the fourth year, they kick in. But I don't know if my younger self could get it. And, just in my example, I taught myself Spanish in my 40s. So I can have a conversation in Spanish. And every time I go to a Spanish speaking place, maybe the first hour or so, I'll struggle. And within a couple of hours, I'll be able to manage. I always thought that I've tried studying languages when I was a kid and I'd been a failure and I thought I was not good with languages. But turns out with language learning, the positive feedback only comes when you reach the intermediate stage. And that comes only in the 1.5 years to 2 years time. But then it's a super positive feedback because you get so excited when you feel like you can actually have conversations and the growth is exponential after that. But most people give up in that stage. They do Duolingo or whatever, and they do it for 100 days. I have a 100-day streak, but nothing's happening. I can't say anything. So I picked that example because my son is doing it. And I was like, okay, this is not the test for whether you're receiving something from the effort should be like on a 5-year basis. So that's what I would tell myself. And I would be a completely different person if I'd known that when I was younger. So that's something I tell all the younger people I meet, but I doubt they get it.
Well, that's wonderful. Well, I think given the moment we are at in markets with sharply volatile short-termism on everyone's mind, I think to have this conversation that started with the arc of adversity and some of what that's taught us, and to end with this, to discuss the importance of long-termism in stock picking, and now to discuss this in our personal lives too. I think it's been a wonderful arc. And thank you so much for coming here, Krishna, and sharing your insights with us.
I loved it. Thank you so much.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear from other inspiring investors and their stories, please subscribe on Apple Podcasts or wherever you get your podcasts. You can find all of our content on the 50 Faces Hub, where you'll find a library of role models, resources, and other solutions to enhance your career. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.